Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Seema Shah with us right now, global strategist for Principal. She's just absolutely lovely about the overall picture. Seema, is there a global picture? Is there a correlation and interdependencies between all these different forces that leads to an optimism on American markets, optimism on stock market, optimism on total return in bonds?
Well, good morning. It's a great question. So, as you said, from a global market perspective, or a global economic perspective, you've got very, very different pictures starting to emerge. You've got the UK, Europe, Japan, and increasingly China in recession or stagnating. And then on the other side, you've got the US doing incredibly well. So one of our questions is, first of course, what is driving that? And I think something is there about the geopolitical tensions, which are really weighing on the various economies. You have China's struggles, which inevitably, given how open that economy is going to be leading to some impact on Europe. But on the other hand, the US is pretty closed. It's actually benefiting, I think. When we look across the global markets, we consider US exceptionalism being maintained for this year. And of course, there could be some downward pressures. They don't entirely escape unscathed from global weakness. But overall, this is certainly another year where the US certainly comes up trump.
And the reason I brought that idea up, Paul, is because I'll steal from anyone. Greg Dacco over at Ernst & Young, EY, has the chart of my day, and it just shows this shocking U.S. exceptionalism from 2021. It's not new.
I mean, and Seema, as a chief global strategist of Principal Asset Management, kind of how do you think about, when you talk to your clients, where do you, can you really talk to them constructively about markets outside of the U.S. right now?
Well, so I think there are a couple of pockets. Right, so typically within emerging markets, we're really thinking about Latin America. That is, you've got the fundamentals in tune, you've got the valuations, because at least, if you're looking at Brazil and Chile, you've actually rarely seen those markets cheaper than they are today. And then they're also in tune with a lot of the secular themes that you're seeing come through for the market. So reshoring, EV vehicles, and the natural resources that go into that. A lot of that comes from Latin America. So that's where things coincide and they look pretty good. But I agree with you. It is a fairly tough conversation with clients at the moment to talk about international markets. And even with portfolio managers, one question that we've had over and over again from an asset allocation perspective is PM asking us, is there ever going to be a time where I'm going to allocate to Europe overweight relative to the US for more than just a tactical trade, more than just 2 or 3 months? And we went away, we did all the research. And the thing that's coming about is you have 3 criteria for that to happen, where Europe really outperforms the US, or at least US exceptionalism doesn't last for more than a couple of months. One is that you have to have US economic growth, of course, weaker than the rest of the world, somewhat unlikely at this point in time. You need to have some kind of trade breakthrough. So think about WTO and the emergence of China. Well, then at that point, the US exceptionalism didn't really work out so well at that point. And then the third thing is that you need some kind of additional secular driver, some kind of technology, which isn't really focused on the US. And on all 3 of those fronts, this year doesn't look particularly positive for international markets. So for that reason, right now, and actually even if I'm looking at the next year or so, it does seem to us that something significant needs to change for the US market to no longer be at the forefront of the equity market gains.
So, Seema, one of the things here as we look to European markets is just valuation. The valuation is so compelling for European markets vis-a-vis the US for a variety of reasons, including the relative lower weighting of tech in Europe than it is in the US. Is that a kind of a trap, a little bit of a value trap, looking at Europe as a value opportunity?
I think unfortunately it is. I've used those words, value trap, myself for when we're talking about Europe, and it does look very attractive. But from a fundamental perspective, the economy really is struggling. we look out over the rest of the year, and for sure, ECB rate cuts will come, and they'll probably come with some kind of urgency, which should add some drive into the European economy. That is likely to happen. But for example, if we look out even further out towards the end of the year, concerns around the US elections and what the impact could be on Europe are really weighing on investors, because they worry. They look from a defense standpoint. If anything were to change with regards to NATO, with regards to Ukraine spending, well, then Europe is sitting at the forefront with potential concerns around natural gas prices returning back to the market. If you think about the trade tensions with China, well, again, who is another major loser from that? It's a European economy. So we are looking at it as a bit of value trap. The only change to that may be if technology were to really disappoint and that starts to drag down the market. We're not thinking that's likely at this point, though.
Seema, it's Synergy Tuesday. Is that what 2024 looks like? Did everybody that's not making it decides they got a mate to take out $1 billion here, $1 billion there?
Well, look, in 2024, our key message to investors has been it's tough Q1. It might even be a tough second quarter of the year, but we need to be getting prepared to deploy your assets. Look at where the value opportunities, where the value and the fundamentals are meeting, of course, not just the value traps, because we do think that the second half of the year is going to be a lot more constructive than what we're seeing right now. And this is a good opportunity for investors to be thinking about where are those synergies and where can they start. They've got a bit of time. They haven't got much time, but they have got some time to start deploying those assets. And it's very important that they start doing so right now.
Thank you. Seema Shah with us this morning with Principal to give us an update. Lots more equity coverage here as you look at the mystery of the stock market. This is such an important interview. She's so young, I don't want to say legend, but Christina Mohr is a legend. She's vice chairman M&A at a small bank called Citigroup, and we're thrilled she's with us today. But she has a deep, trenchant experience in the ebbs and flows of what we do, economics, finance, investment, and folding it into international relations. There's the great story of Lawrence Summers sitting for his oral. And the professor said, well, we survived that. You had it on the other side of it. He had the chalk in his hand. Stan Fisher told me once that Paul Samuel was so angry at him that he grabbed the chalk out of Stanley Fisher's hands and threw it against the board. What was it like having Lawrence Summers as your teaching assistant at a small Charles River school? That must have been like the worst in the world.
It was an honor, actually. He's so smart and he's so practical that he made economics easy for even those of us who were countering.
Did he grade like Steve Roach at Yale, where there was a quality C?
I wouldn't know. I didn't get close to that side of the scale.
Okay. Why do we know that? Christina Mohr with us here on the M&A of the day. What a perfect day to have you in here. It's Synergy Thursday.
It's Merger Monday.
Yes.
Well, it's Tuesday, though, but she's working a 5-day week at Citigroup, Jane, just so you know, she didn't take Monday off. Let me get to the chase. Does Synergy work?
Yes. I think that what you've seen in the last half of last year and what you're seeing in the first 2 months of this year is the return of the corporate acquisition. Corporate acquirers were about 80% of the market, have been 80% of the market so far this year. We're about 70% of the North American market last year. This is all driven by the need to demonstrate growth and, importantly, the need to show greater margins. Let me back up for a minute and explain this. If we look at some of the work we've done internally on what drives stock price performance and returns, growth is probably, superior growth is probably responsible for about 2 turns on an EBITDA basis for market performance in 2023. But margin improvement is another 2 turns.
So that's synergies. Do you see, come on, there's like 3 major mergers today, including the Barclays at Reorg, which I don't want you to comment on. But the bottom line is they got to cut Paul billions here. I mean, they got to cut billions of costs, right?
I think that I haven't seen the numbers yet on the Capital One Discover merger today, but certainly cost savings and cost synergies, utilizing the platform more aggressively, are an important part of what drives the economics, in particular, of stock transactions, such as, say, the Capital One Discover merger. But the other part of the synergy equation, and it doesn't really get talked about in the announcement. It really doesn't get valued as much by the analysts. But an important part of the synergy equation are revenue and platform synergies. And I think that's one of the things that you will see in some of these large acquisitions, both on the energy side, on the healthcare side. Certainly, I think that'll be an important part of the acquisition that was announced today.
So, Christina, on the Bloomberg terminal, we have a great function, MA Go. And every time I see a trade cross the tape, I go MA Go to see which of my friends on Wall Street are getting paid. Now I don't look at that anymore. Now I look at see who the legal representatives are, because I think they are more important than the bankers today, because I've got some regulators down in Washington, D.C., that I don't think they're very merger friendly. Talk to us about the regulatory environment for getting deals approved. It seems like the regulators are really looking at a lot of deals, a lot of industries.
Sure. I think that obviously this administration's level of enforcement has been more active. They have put forward new merger guidelines for the first time since 2010 that we've seen a change in those merger guidelines. They're certainly more aggressive. They have lower levels of concentration, certainly lower market share targets, and indeed take some novel approaches to enforcement, such as compound acquirers, some aspects of vertical integration. So certainly the DOJ and the FTC have become more vocal and more active. But when we actually look at what's happened over the past year, when these challenges have been taken to court, you've seen the courts react a little differently. You've seen the courts adhering a little more directly to the 2010 level of 2010 guidelines. So I think it's become a little clearer what the cans and cannots do. But certainly, I would always hire a good lawyer if I were doing a deal.
Exactly.
And certainly in this environment, if you're doing the kind of horizontal mergers that are the flavor of the day, you certainly want to make sure that you have the right antitrust counsel.
Well, Capital One's got Wachtell Lipton, and Discover's got Sullivan Cromwell, so two pretty good firms right there. So talk to us here about 2024. I mean, are we going to have more activity simply because the market anticipates rates coming down, and maybe some of your clients are going to be a little bit more inclined to be aggressive?
Certainly. I think that, I think there are three parts of the merger market, all of which have the prospect for improving in 2024. First, we've talked a little bit about the strategic acquirers. I think that the combination of the increased corporate confidence, the fact that what you're seeing among the strategic acquirers is the real benefits that the larger strategics, in particular those that have like A ratings and above, have in terms of benefit of the cost of capital. They have cheaper costs of capital and the ability to out-earn almost anyone.
To me, that's the heart of the matter. Nassim Taleb says the gravity's returned to the market, including your M&A world. The answer is money was nothing. Dire straits. Okay?
Yeah.
Now money costs something. That's going to have us with an M&A frenzy, what I called last year the Great American Roll-Up. Isn't that what we're going to see?
I think we're going to see increased strategic activity. As I said, corporate confidence, cost of capital, those types, and the search for growth and margin improvement. That certainly will continue to drive the strategic dialogue. And I think we see that amongst all of our clients. The second part of the market that is important is the corporate deconsolidations, the spin-offs, for example. Last year, we saw about $400 billion of spin-off transactions, about 25% of the market, certainly more than we've seen on average. And that's being driven by the fact that if you look across America, or across the S&P 500, rather, almost 30% of the multi-divisional companies have divisions that aren't earning their cost of capital. I think that's driving spin-off activity, that's driving corporate divestiture activity. That'll be an important part of what happens this year. And finally, you have the financial sponsor market, which in 2023 was at its lowest level since 2013 at about $535 billion. That market, with rate stability, with improvements in the high yield market, with the 1.5 trillion of cash that's dry powder that's available among the sponsors, that market is set to improve.
Can you come back, because we wanted this to be a 2-hour conversation.
That's a long subway ride from 388 Greenwich.
It is. Are
And
you
still the worst
are you
elevators.
downtown at Greenwich, or are you at Midtown?
Oh, we're down at
The
our
worst
corporate
elevators.
headquarters.
The worst elevators on Wall Street.
They are.
But we have some of the best people.
Yes, you do. Absolutely.
Okay. Christina Mohr of Citigroup. Thank you so much. Let's do this again. This is a joy and an honor, and I'm going to frame this the only way I can do it. Stephen Roach of Morgan Stanley and Yale is certain I'm a fraud. And he knows that because I'll go, well, I just got back from China. And my China is the airport where you go down the arrivals and there's a big Morgan Stanley banner across the top signaling Morgan Stanley's commitment to China, to the Pacific Rim. And then there's the car, usually fancy, to the Mandarin. And then there's meetings in 3 skyscrapers. And then I get back in the car and go back to the airport, go home, and I say I went to China. Stephen Roach has been to China. And the single sentence here, folks, off of his FT essay, which was viral here, it pains me to admit it, but Hong Kong is now over. Forever from Morgan Stanley and Yale University, Stephen Roach. Stephen, what a painful essay to write. When was Hong Kong over?
Well, it's been a gradual process, Tom. Always good to be with you, by the way, and reminisce over the way it used to be. There was a lot of hand-wringing over the time of the handover from to the PRC in 1997. And that hand-wringing was very much overblown at the time. I mean, Hong Kong enjoyed an extraordinary burst of economic activity, financial market vitality, as the Chinese growth and development story exploded. But in the last several years, and I guess the turning point were the massive protests and demonstrations of late 2019 that evoked a sharp political response from the PRC. That, in conjunction with COVID, with the severe structural headwinds bearing down on the Chinese economy, and with the intensified conflict between the U.S. and China that has left Hong Kong sort of stuck in the crossfire, all of that has come together to really paint a much more dire picture than we'd like to think.
Stephen, my dialogue with Chris Patten, Lord Patten, who is the British representative to this debacle, there's always been great emotion, including the day it was given up and different other signposts along the way. Can the Chinese find a middle ground? Can Beijing find a new Hong Kong that alludes to what you and Lord Patten knew?
I think it's going to be hard to recreate the Hong Kong that we all loved. I mean, you got to be careful here. I mean, I love Hong Kong. I still do. I have great friends there. I go back there a lot. I was there 3 times last year, even though one of the Hong Kong legislators wrote in a letter to the FT that I hadn't been there in years. I've got great friends and contacts and a wonderful history there. But, just like an investor should not be in love with a stock when it reaches a valuation target, I think you got to be careful about being in love with a city or a system or a nation and letting that cloud your analytical assessment of the problems.
So, Stephen, I just coincidentally, I happened to be in Hong Kong the exact day of the handover. And, back in the day, you had, if you were on global Wall Street, you had to do a tour of duty in Hong Kong. Much like in the 80s, you had to do a tour of duty in Tokyo. Where do the Western financial institutions, how are they viewing Hong Kong going forward?
Well, I think there's an understandable concern over the future of Hong Kong. My old firm, Morgan Stanley, is very committed to Hong Kong right now. It's the headquarters of the Asian operations, excluding Japan. And yet, when you go back and talk to people, at least in 2023, they want to feel optimistic. They want to believe that Hong Kong is still a sustainable platform for business. But there's a nervous. They're looking over their shoulder, and they live through these massive, unprecedented protests, and they focus very much on what is going on in Beijing and Xi Jinping's very tough,
Right.
Ideologically driven clampdown on the PRC, and they know that has implications for Hong Kong as well.
It's interesting, Stephen. It just kind of goes to the greater issue. There obviously are geopolitical tensions between the West and China seemingly growing in scale, yet we still see Western business leaders going to China, Tim Cook, whoever you want, Elon Musk. How do you think the Western corporate world is viewing Greater China these days?
Well, like I was with, at the same meeting that Tim Cook was in last March when he sort of made a token appearance to the China Development Forum. He was in and out. It was not necessarily, a man who wanted to roll up his sleeves and go to work in trying to understand what was going on in China. He did it because, as he said, when he met with the premier, Apple was celebrating its 30th anniversary of being present in China, and they have a major commitment to that. A few weeks later, he was in India opening a new store in Mumbai and talking about Apple's new commitment to India as well. So, there's again, they're hedging their bets.
Right, Steve, I want to talk about accidental conflict. Roach writes prolifically, folks. See, he's over at Yale, like Christina Mohr is talking about Harvard doing an easy A. There's no easy A at Yale.
No.
I mean, Roach is giving out quality C's like nobody. Steve, you did accidental conflict, America, China, and the clash of the false narratives. And it made me think of the great Catherine Mann, now at the Bank of England, and the idea of the codependency between China and the United States. Is our codependency unchanged? How did you address that in accidental conflict?
Well, I argued, Tom, that the codependency framework is still a good framework to describe the relationship. But as is the case in human relationships, it's a precarious relationship between individuals and, I would dare say, economies. And when one partner, in this case, one economy, starts to go its own way, the other feels scorned and lashes back, and conflict emerges. And we're now in, what psychologists who study human codependency would call the classic conflict phase of codependency. And, that's the quagmire that is proving so difficult to climb out of.
Stephen Roach, thank you for being with us today to start this week off strong on a Tuesday. Stephen Roach, of course, I just can't say enough about the effort. Accidental conflict. I said it was anticipated, and yes, it was. Kirk is just, within there. The Financial Times makes it a best book of the year in economics, and that's frankly to be expected from Dr. Roach. Stephen Roach of Yale University. Lisa Mateo here with the newspapers this morning. They were so adult. They were so like, go to class at NYU or whatever. I'm like, Lisa, give me something light. What do you start with this morning, Lisa?
Well, we're We're talking about
The blue
teachers.
button, the Detroit Lions,
the
the blue
Detroit
button
Lions
over there.
blue
Press
button.
it.
It would help. Crazy day today. Teachers, a lot more are taking sick days since the pandemic. So there is a shortage of substitutes, apparently. So this is happening a lot.
Okay, I'll be the evil one.
Oh,
Don't
no,
they get
go
a
ahead.
sick day for 3 months in the summer?
Well, here's the thing. They they receive paid sick days and a small number of personal days too. But here's the thing, over 2022, 2023 in New York City, nearly 1 in 5 public school teachers, they were absent about 11 days or more. So it's increasing. That was higher from the previous year and from before the pandemic.
Yeah.
I mean, my daughter sees it. You know, there's always and it's not even because they're sick, but because someone in their family, like they get things to take care of.
And just in my town, on the grounds of the high school are signs planted, substitute teachers
Really?
needed, you know, and I hadn't seen that before. So, and this is in a good school district. So I think it's just
the classwork with a substitute teacher
Exactly.
is so successful.
Exactly. I just think it just feels like people, I don't know, I think post-pandemic, their work-life balance has changed and people are like,
I agree.
I just think on the balance, I'm going to be a little bit more life, a little bit less
I
work.
agree.
And if you're a teacher, that means
I
sick
mean,
days.
contrary to what people think, I have no social life, and we're trying. We're like forcing ourselves to get out of pandemic. Like, you know, I'm in sweatpants and, you know, Lululemon
With a bow tie.
things all weekend, and I'm like, okay, get dressed, go out, do something. Are you still there, Lisa? Or are you like out 5 days a
I'm
week?
still on the thought of you and Lululemon.
Yeah. That's a tough image, right?
It's painful to see. Why don't we find another theme to save the show on YouTube and Apple CarPlay?
Okay, the Lerner family apparently no longer exploring a sale of the Washington Nationals. This is from Mark Lerner. He's the club's managing principal owner. He told this to the Washington Post on Monday. So apparently they came up with the decision a while ago. They say they're very happy with owning the team, bringing back a ring one day because they won the World Series back in 2019. But there's been a lot of uncertainty around it.
And I'm surprised they took this off the market because we just saw the Baltimore Orioles trade recently. And what we've seen in professional sports is these values continue to go higher and higher and higher. And no matter who you are and what franchise, there's somebody out there willing to pay a big number for your. So I'd be surprised if they didn't get good interest for their team. So it's probably a family dynamic thing.
Just quickly here, Ted Lerner, starting with $250 borrowed from his wife, I think, built the Washington real estate combine that took the Montreal Expos to Washington. And the family's got a huge attachment, to say the least.
Yep.
I guess David Rubenstein's not going to bid because
He owns
he's
Orioles,
Northwest. And the media there is so complex.
I think it's amazing that
there.
amazing that there are two, there's two towns, Baltimore and Washington, literally 30, 40 miles apart, each have franchises.
It's like the old days.
Yeah, and football and baseball. It's amazing how the leagues allow that, but it works.
Next.
All right. Do you remember the Salt Bay? You know, the one who does this over there. You got to look on YouTube.
But that's in London, in the steakhouse or something?
Correct.
Okay.
The steakhouse in London. He does that little viral sprinkling across the steaks. He has his own restaurant there. So you know that energy prices are sky high over in the UK. So this is just an example of how much of reality this set in. Yeah. That restaurant, it's become, popular, but they are turning off their central heating after closing during peak hours when heating demand is lower, and they're turning off lights during closing hours. So they're trying to penny pinch, I guess, everywhere
this is
you
in
can because the
the Park Tower Hotel in Knightsbridge, which Tom is familiar with, because they have the 680-pound Wagyu strip loin or the 630-pound giant tomahawk steak.
It's crazy.
All over that, Tom.
Yeah, it is. Well, I go to Rules. I sit at Francine Lacroix and I have a table at Rules right by the window. We look back, and I've actually sat at the James Bond table at Rules where they filmed one of the movies, and that's like authentic. Like the stuff is tasteless. I mean, Francine's chowing it down, and it's like just too much of cuisine over there. It's too rich for me. And all that, but. The heating bills, Jon Ferro's been really, really articulate on this. It's not like America. There's some real hardship there in families' utility bills.
It is. It's amazing. And but the economy there is just not picked up like we have here in the U.S.
Well, to say the least. Futures negative 16. Lisa Mateo, thank you so much. Is there? Did you see she hasn't worn her Yankees jacket since pitchers and catchers?
We're waiting for opening day.
Her daughter has it.
Yep.
is absconded.
I'm looking at rules right here. Okay, lots of stars there, Tom.
Yeah, lots of stuff. Yeah,
Maiden Lane in London. Lots of stars.
They treat me wonderful.
Oldest restaurant in London. It served traditional British
I walk
food.
in and they make a Dickensian swirl, and then Francine walks in and it's like the place stops.
Of course.
Oh my God, it's Francine Lacroix. I don't even exist. That's it, rules. You have a window seat.
We'll do that.
Francine sits
We'll
by
do
the
that next time.
windows. And it's like unedible.
Right.
They have a cocktail bar upstairs that's literally out of the movies. Rules in London is something to try once. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.